Hello and welcome to the Evershed Sutherland webcast. Evershed Sutherland and Georgeson present the latest developments in shareholder activism for BDCs and closed-end funds. If you have questions during the webcast, please submit them via the Ask a Question text box on your viewing console. I will now turn it over to Cynthia Cruz, Executive Partner at Evershed Sutherland.
Good afternoon, everyone. My name is Cynthia Cruz, and I'd like to welcome you to the Evershed Sutherland webcast. We're going to discuss activism with BDCs and closed-end funds today. I'm joined today by Christopher Hayden, Chief Operating Officer, and Hannah Orowitz of Georgeson. Chris and Hannah, could you please tell me a little bit about yourselves?
Sure. This is Chris speaking. I've been with Georgeson for nearly 25 years. In my current role, I'm the Chief Operating Officer of the U.S. proxy business. A good chunk of my time is spent counseling closed-end funds and BDCs on the very matters we're going to discuss today, which is activism.
This is Hannah. I have been with Georgeson for just under a year. I'm Managing Director for Corporate Governance and work with our clients on a variety of governance matters, and began my career as a lawyer at Sutherland in the BDC space. So excited to be here.
So great. We're going to try and make this a little bit interactive, and just Chris and I have actually worked on some shareholder activist cases in the past, or campaigns, and so we're going to try and make this as timely and interesting as possible. I do want to remind you, with a housekeeping note, just that there is a box where you can ask a question. We'll try and integrate the questions into our answers. If we don't get to a question that you've asked, if you put your information in the box, we'll get back to you separately. Also, there will be a final version of the webcast on publicly traded privateequity.com, as well as the BDC Essentials app. So, Chris, let's jump into it. What are the current trends in shareholder activism across the closed-end fund and BDC industries?
Sure. Thank you, Cynthia. So maybe we'll just start with an overall primer on activism in the broader market and then narrow ourselves down to closed ends and BDCs. So activism impacts companies in all industries and across all market capitalizations. No company is immune from activism. Even the most successful companies have faced activists. Companies such as Apple a few years back had to face Carl Icahn when they had too much cash on their books. Companies that are facing operational difficulties are subject to demands, as are companies whose capital structure is not optimal. Activism is rampant as investors are trying to show alpha. The active managers are facing increased pressure from the migration of assets to more passive and index investments. Those active investors will use the tools in the activist toolkit to try and differentiate themselves. So we'll spend today focusing primarily on the closed-end funds and business development company space. Most of our focus will be on proxy contests and shareholder proposals. That said, we should probably define what a proxy contest actually is, because we find that the media often mischaracterizes what is a proxy contest. Proxy contest is when a dissident shareholder actually mails their own form of proxy card and seeks voting authority from shareholders. Proxy contest means that the process and tools typical of an annual meeting get modified substantially. Most often, proxy contests are about board seats, but on rare occasions, proxy fights have been used to block mergers in the BDC space, especially. We'll also talk about shareholder proposals, and in that case, we're referring to the process in which a shareholder can submit a proposal to the issuer for inclusion in the issuer's proxy statement. Depending upon the subject matter, these proposals may be advisory or precatory in nature. Certain proposals, however, such as the termination of a manager, may be binding. Examples of a common shareholder proposal would be a proposal to de-stagger a board or, as I mentioned previously, terminate a manager. In each of the past couple of years, there have been somewhere between 450 and 500 U.S. companies that have been subject to activist demand. And according to data from FactSet, nearly two-thirds of those get settled before actually going to a proxy fight. So we're really talking about something like 180 or some number like that in which a proxy statement is filed, and then it gets narrowed down to the true number that goes all the way.
I've seen the number that actually, that taking into account, this could be about 231 seats or director seats, and that actually, most of that is doesn't actually go through the full fruition of a proxy campaign, but there's about 21 seats that actually changed hands in a hostile or aggressive activism circumstance.
And that truly shows, how rare it is for something to go all the way to a proxy fight. So as it pertains to business development companies and closed ends, there's been an uptick in campaigns over the past 5 years. Over those 5 years, we've seen an average of around 28 activist campaigns in the BDC and closed-end fund space. And this year, we're aware of 8 campaigns already in the first 2 months of the year.
Well, it started last year, didn't it? I mean, back when we're going to talk a little more detail, that if you went from June until the end of the year, you had about 9 campaigns initiated, and some of them have completed, others haven't. But it's there really has been an uptick. One of the numbers that you had told me about was that about 13% of all activism is in the closed-end fund space, which I think is shocking because there's certainly not there's not the asset base. There's a lot of industries that are much larger than the closed-end fund space or BDCs.
Yeah, that is accurate. Yeah, 13% of all situations where a board seat was sought actually is in the BDC or closed-end fund space. So I find that a remarkable statistic.
So going on to one of the things that I would want to point out as well is there was a little bit of in just the overall industry, there was a little bit of a downtick, but it really wasn't substantial. All the numbers that we've already been giving you would make you want to plan or pay attention to the whole activism area. One of the things I'd want to mention is that the NACD, the National Association of Corporate Directors, said that 50% of issuers don't have a plan for an activism campaign. So it's we're going to focus on that a little bit after we talk about some of the campaigns that have gone on, but I just want to make sure that everybody understands that this is something that you need to potentially plan for.
So why don't we dive into who some of the activists are and what it is they're looking for in this space. So it's a highly concentrated group of investors that make up the vast majority of activism in the closed-end and BDC space. Some of the names we'll discuss today are Bulldog Investors, Saba, Carpus, Matisse, and Stillwell. For the closed-end funds, these shareholders typically are looking to find a way to realize net asset value. As you know, closed-end funds typically trade at a discount, and activists are looking to shrink that discount. In the BDC space, we find that more of the activism is focused around M&A. Last year, there were 19 proxy fights in this space. At closed-end funds, 7 were led by Saba seeking board seats, 8 by a firm named Dryden at a single complex in which they were seeking a preferred board seat, and 1 by Bulldog where they opposed a new advisory agreement. There were 3 situations in the BDC space led by 3 different investors. All 3 were M&A related. There were a dozen shareholder proposals outside of proxy fights, all of which were at closed-end funds. Saba submitted 5 proposals to destagger boards. Matisse submitted 5 proposals to terminate the manager. Bulldog submitted 1 to liquidate a fund, and Carpus submitted 1 to have the issuer conduct a self-tender offer. This year, we're aware of 5 threatened fights, 3 being led by Bulldog, 1 by Saba, and 1 by Stillwell at a BDC. In the case of the BDC, Stillwell threatened to fight in 2021 if the BDC is not sold by then. This comes after the BDC has already announced that they're running a strategic review process.
And just to give folks a little bit of an understanding of how much this has been in how much activity there's been in the BDC space since 2010, there's been about 20 different campaigns. And there, I would say that, as Chris mentioned, a lot of that relates to mergers and acquisitions activity, but there is at least about, I would say, 10 in that time frame that were also involving shareholder proposals, an effort to terminate the investment advisory agreement, things along those lines. And I would mention that Goldstein has been one of the most active activists in the BDC space, and he's actually won a couple of those actual campaigns.
We'll dive into him individually in a bit here, I believe. So, as we enter 2020, or in the beginning of 2020, we know of 8 shareholder proposals. SABA has already submitted 4. 3 of those are seeking self-tenders, and 1 is requesting that an issuer adopt plurality voting as opposed to majority voting. Carpus has submitted 2 proposals also seeking self-tenders, and a less frequent investor in the space called Dolphin has submitted a proposal to terminate an existing management agreement with an advisor. Finally, Winfield has submitted a proposal to liquidate 1 BDC. And all of these situations I mentioned are public and in the public domain, but there are likely other situations where the negotiations are happening behind the scenes, and for those we're not necessarily privy to.
Right. I mean, there is a component of this that it's not uncommon for an activist to start talking to management first, and then we'll do that informally on a confidential basis. And then very well, if they're not successful, they may very well go to a much more formal public stance. So there could be a lot more activity going on that we're not necessarily aware of. Maybe you could just, I'm not sure that everybody's familiar with a self-tender. Can you explain what that proposal is?
Sure. So that is a proposal where the activist investor puts in a precatory proposal requesting it would show up in management's proxy statement. Shareholders would be given the opportunity to vote upon it. The proposal itself asks that the issuer, whether it's the closed-end fund or the BDC, does a self-tender offer or essentially repurchases shares in their own fund, and it's typically at some percentage of net asset value. So most often it's 98%, but sometimes it may be a little higher or a little lower. And the percent of shares that the issuer would purchase, we've seen requests anywhere from 5 to 60% of the outstanding. There's been a recent trend where some of the proposals ask, say, do a self-tender, and if more than 50% of the shareholders actually submit tender instructions, that you would then go to a liquidation vote instead. So it's a way for an activist holding a large position to get liquidity in what's generally an otherwise fairly illiquid investment. And that's one of the underlying issues we face in closed-end funds when you get these large activists. They may hold 15, 20, 25% of a fund, and quite frankly, there's no easy way for them to get out in regular way trading.
And you mentioned the precatory versus mandatory, and in the context of the self-tender, it's precatory, it's voluntary. You have to have a board action to undertake to do that, and you're taking the initiative of the shareholders. So if you get a vote of over 50%, then you go ahead with a self-tender or something along those lines, but you still have to have the board take action to do that. So it's not as though the shareholder, the proposal requires you to do something. Certainly most boards will take the influence of the shareholders, but that's one way. You also mentioned liquidation. Is that the same type of a precatory or mandatory?
I believe liquidation is, both of those are precatory, and what Cynthia said is actually important because yes, the board does have, the ability to potentially implement the proposal or not. However, if they choose not to follow shareholders' requests and more than 50% of the votes cast on the proposal vote in favor of it, ISS and other advisory firms will frown upon that at the following year and potentially vote against the board of directors. Proposals such as a fire the manager, however, are binding.
let's not say fire the manager, let's say terminate the investment advisory agreement. That is precisely the point I was trying to get to, is that a shareholder proposal likely has two steps to it at least. Whereas if you're talking about termination of manager, that could actually require you to actually terminate the investment advisory agreement with the vote. Now, of course, that doesn't allow the activists to take over the company. At that point, you technically have to have an additional vote to do that, or have the board and shareholders vote. So it still can be a two-step, but as far as the advisor being terminated, that happens as a result of that first vote. And so it is important on whether you're talking about mandatory versus voluntary, and distinguishing between some of these tactics. Maybe just to talk for a second and make this more of an appointment example with the Saba BlackRock situation.
Sure. Yeah. No, maybe I'll give a little bio about each of those couple of firms. So Bulldog, which Cynthia mentioned, is a frequent part of the frequent flyer club in both the closed-end fund and activist space, is run by a fellow named Phil Goldstein. He was earlier in his career a civil engineer for the city of New York, and then in the early 90s migrated into money management. He has about $400 million under management, and he has launched 210 campaigns since 1997, of which 103 were proxy contests. And I was joking earlier with Cynthia when I was doing some homework for this presentation that I printed out a, quote, summary of Goldstein's activities from one of our data providers, and it was 93 pages long.
Wow. My understanding is, and he said this publicly, that he does this mostly from his kitchen table. Not sure if that's true or not, but and he's had some success.
He has. He has definitely had success, and right now I believe he serves on 7 boards. And he's taken on the management agreement of one fund, and there's another fund where he's serving on I believe they're calling it a transitional investment committee for sort of a fund that's
right
in transition.
Right. And when I say success, I'm saying successfully taking the action that he was trying to pursue, meaning that he was either taking over the company because of an investment management contract being terminated, or that he was actually able to get folks on the board in a proxy contest. And this has happened quite a few times in the BDC space. I'd pause just for 1 second and he has a lot of interaction with the SEC. He has a letter into the SEC where he actually is making certain assertions about governance procedures that he doesn't think comply with the 40 Act. For example, if you don't get a sufficient vote for your directors, you have carryover directors, and his assertion is that if you have carryover directors, those don't meet the 40 Act requirements. So there's a couple of other things that he's requesting, but the SEC currently is looking at governance requirements. And so I do think that part of his letter that he submitted is, some of those things I believe would be taken up when the SEC comes out with some advice regarding governance.
And I guess my final comment about Mr. Goldstein is that he is not afraid to litigate at all. So he regularly will
yes.
go all the way. And
having been on the opposite side of Mr. Goldstein, I am aware that he does like to litigate.
Maybe we'll talk a little bit about Saba, and they're a newer but larger participant in the activist space. They have about $4 billion in assets under management, and they've launched 33 campaigns since 2016, of which 18 were proxy contests. The difference with Saba, since they have a larger war chest, they are very aggressive and often will buy stakes in excess of 20%. So not at all unusual to see them buy a position that large. We understand that they will often hedge some or many of their investments, and they're less interested in the performance of the underlying assets and more interested in shrinking the discount as a result of that. They too are not afraid to litigate. To date, I don't know of any board seats that Saba has won, but they have been successful in getting some of their shareholder proposals passed. And the reason they do that is they know that proposals, particularly proposals to de-stagger the board, are very popular with institutional investors and ISS alike. And they know that if they put in a proposal that they'll likely get a victory, or at least partially, and it will give them a feather in their cap to say that they at least have a partial victory.
When they came out, I think just yesterday, there's in one of the BlackRock campaigns that the fund that was targeted actually is now, the closed-end fund is going to be merged into a mutual fund, which will obviously get rid of any discount. But the campaign, I think, was they weren't necessarily successful with everything they did, but they were able to basically move that along, or move management along on putting forward that merger.
Maybe we'll talk a little bit about a couple more closed ends, and then one investor that's a little more specific to the BDC space. So Carpus is another closed-end fund. They too are fairly large in size, about $3.5 billion in assets under management, and they've run 134 campaigns since 1997, of which 48 were proxy fights. They too will buy very large stakes in closed-end funds. And I've also seen Carpus in the past go after a series of closed-end funds that were engaged in a change in control. So the manager was going through a change in control process, and Carpus used the vote at the underlying closed-end funds as a leverage point. So they're fairly savvy in their tactics. Matisse is less frequent, or Matisse, also known as Deschutes, I believe. They're less frequent. They submitted 5 proposals last year to terminate the manager. I haven't seen them run any proxy contests, and to my knowledge, none of those 5 proposals passed. Finally, on the BDC side, I'll highlight one of the more recent prolific investors, and that would be Stillwell Value Group. They have about $200 million under management, and they've been involved in 90 campaigns since 2010, of which 28 were proxy contests. Now, not all of those were BDCs by any measure. They're more frequently known for investing in small banks and other financial services companies, REITs, things of the like. They have threatened activities at 2 BDCs. In the case of one, which will be the only issuer I'll mention today, simply because they don't exist any longer, but in the case of Alcentra, Stillwell filed their first 13D in late 2017 with an 8% position, only stating, quote, "We hope to work with the issuer to reduce its share price's discount to net asset value." About a year later, they changed the disclosure in their 13D to, quote, "We informed management at a meeting on January 5th, 2018, and reiterated several times throughout the year that if the issuer does not repurchase 10% of its shares in 2018, we will aggressively seek board representation." January 2019, they amended their 13D to state that they indeed did serve notice of intent to nominate 2 nominees for election at Alcentra's then upcoming annual meeting. Shortly thereafter, in April of 2019, Alcentra announced it was conducting a strategic alternatives review. A couple of weeks after that, Stillwell sent a letter to Alcentra's shareholders stating their belief that Alcentra should be sold. And then a few months thereafter, in August 2019, Alcentra announced it had entered a merger agreement with Crescent. And Stillwell at that time was quoted in the media shortly thereafter stating, quote, "It's a good deal and I'm pleased with the outcome." So the merger went to a shareholder vote earlier this year and was approved by shareholders. There's another situation this year in which Stillwell has announced its intention to run a proxy fight in 2021 if the issuer is not sold by then. In this case, the issuer has already announced that a strategic review process, and that issuer announcement was done before Stillwell publicly announced their intention to run a proxy fight.
And the outline that Chris just went through is very common in the BDC space, to the extent that there is some that you're trading below NAV, or there's some other issue that the investor may have. But the actual playbook that you just went through, you could apply that to at least 3 or 4 different situations in the BDC space over the last 10 years, where, like I said, that's been the most active in M&A kind of context.
So maybe we pivot to what are the demands and what is it they really want. And we touched a little bit about tenders earlier, but there's a few other items that they will frequently request. So all of them ultimately are, or nearly all of them, revolve around getting net asset value or shrinking the discount to net asset value. The tender offers, as I mentioned, the dissident will seek a request and ask the issuer to tender anywhere from 5 to 60% of the fund at somewhere near or close to NAV. The downside to tenders is they really only shrink the discount for a very short period of time, and that there's not a long-term narrowing of the discount. These proposals also result in the remaining shareholders essentially stuck holding the bag, for lack of a better phrase, where they're a smaller group of shareholders is sharing the costs now.
Well, and the activists very well might have done very well in that tender. So they may, even if they weren't able to get, for example, their nominees on the board, if they were able to get a tender and did tender into that, that would be considered a success and might actually explain why there's so much money that's been gone into this space as far as activist investors or funds, excuse me.
A flavor of that one-time tender are interval fund-like tenders where the activist wants a series of tenders over a year or 2 years or 3 years, where there may be a larger tender up front and then follow-up tenders of 5 or 10% once a year or once every 6 months or some schedule like that. Another situation, and Cynthia touched on one earlier, but some funds have merged existing closed ends into open ends or otherwise open-ended at closed end. And what we see is this will typically result in large outflows quickly after the merger or open ending. Now, some funds may put the new assets in a merged or open-ended fund into a special class that will have a higher sales fee for a fixed period of time. However, the downside to that is by moving to an open-end structure, you remove the ability to use leverage, which is obviously one of the key benefits of a closed-end fund. Liquidation, I guess, of course, delivers net asset value, but it can very much be a long, drawn-out process. The situation that Cynthia and I were involved in, Mr. Goldstein has now taken north of 5 years to liquidate, and I don't think he's done yet.
Yeah. Well, and sometimes those situations you don't have to even actually do an externalization, meaning having effectively a contract that has an advisor attached to it. You could just manage internally. Although what I would suggest to you is if that goes on for 5 years and there's liquidation, that means there's expenses in running the company for that period of time, even though you had told people you were going to liquidate. But liquidating a BDC portfolio, as I think a lot of the activists have seen, is not necessarily an easy thing, since what BDCs generally invest in are illiquid positions. So it's a little bit of a misnomer.
The final demand we see revolves around changing the manager. So this doesn't do anything about curing discounts to NAV. However, every once in a while, we'll see a scenario where somebody is looking to change the manager. Perhaps the activist perceives there to be underperformance, but that's not nearly as frequent.
Yeah, it's a higher vote to actually terminate an advisory agreement, and so it's more common to actually get a shareholder proposal that's voluntary to either to potentially have the board consider a strategic alternative or consider a liquidation. So it's one of those things that it's harder to do. One of the things I would point out, though, is actually can be done at any time because the way the 40 Act works is that it requires that the shareholders should be able to ask for that. But again, you have to ask for it, and you have to put together all the proxy materials, get out and do the campaign, actually get out and do the vote. So all of those things are issues that arise with trying to terminate an advisory agreement.
And I would say sometimes we see dissidents put in a proposal that says terminate the advisor, but doesn't provide an alternative.
Right.
So what are you going to do with the fund? Are you going to orphan it? And
Right. Right. Yeah, I mean,
mainstream investors don't like that concept.
exactly. If you terminate the investment management agreement, you don't have somebody standing there to take over. What happens to the portfolio? I mean, the board's going to have to put somebody in place and do something along those lines. But it does. I think orphan is a pretty good way to characterize it.
Maybe now we'll pivot to the typical activist playbook and some of the methods they'll use.
Well, let's in that context, let's talk a little bit about the facts of nominees. How does someone actually initiate putting a different slate of directors? And what I'm trying to get to is a case that just occurred this past year, and it's something that managers might come up against. Is that a slate of directors to go against the management directors, and this was the BlackRock case that I'm referring to, where the put in. The BlackRock returned a questionnaire, which the Delaware court went on to say that it was a 47-page questionnaire, and the lower court in the Delaware context decided that that was too extensive. That wasn't reasonable to ask the slate of directors to fill that out, and they only had 5 days to do it. Saba never told BlackRock, according to the record, what was that they were or weren't going to fill this out. And then when it went up to the higher court in Delaware, effectively clear bylaws that say that you have an advance notice provision, and you do what they would consider to be reasonable, they're going to stand behind you. So the court actually stood behind BlackRock and said that what their actions were appropriate. And so one of the things I want to make sure we talk about is reasonableness here comes into play quite a bit. But the court actually stood behind the company and their provision. So when you're looking at a plan and deciding how you want to react, you want to make sure you looked into your bylaws. What is your advance notice provision? How would you deal with it? And even though it was successful for the company, that took over 6 months, which is short to deal with that and go through that whole court process.
So that was, I'll limit my comments on that particular case due to BlackRock being a client, but I will talk more generally kind of how activists get to that point and how they get to nominations. So most typically they will quietly buy a large position in a fund or BDC that's trading at a substantial discount. And the first shot across the radar often is a call to the advisor with fairly pointed questions, something along the lines of, hey, you're trading out of line with your peers, what's going on? And again, it's a small universe of investors that do it, so the name should be known to all of the listeners on this call. Next step, when they likely don't get a satisfactory answer, is to send a letter to the board complaining. And often the investor will file this letter as a press release or 13D. 13D if they're over 5, press release if they're under 5%. Shortly thereafter, and this is where the fun part begins, is a second communication will often come across, and this will include a nomination for board seats and or the submission of a shareholder proposal for inclusion in management's proxy potential. Once the board has received the nomination, then as Cynthia can probably expand upon, the board, has to look at the validity of that nomination and the underlying candidates.
Right, and when you're looking at that, so commonly the bylaws will explain that you need the bio, the background, any conflicts, whether there's independence, but as I mentioned, the questionnaire is not set forth in your bylaws on how you would, what you can or can't ask. And in the 40 Act context, I do think that, for example, there's more reason to ask more questions because of the fact that if you don't have independence, you may, the board may not be able to act or be in compliance. So there's a lot of leeway on how to do that. But if you were to, and most management teams, if you're talking about putting a slate that looks like a campaign, proxy campaign, you're likely not necessarily going to put those in your proxy materials. So
next stage is you'll often see the dissident shareholder file a preliminary proxy, and in contested situations, the proxy does need to be filed preliminarily with the SEC and is subject to SEC review. Similarly, on the management side, if management is going to make any mention of the contested meeting, then they too are obligated to file a preliminary proxy and are subject to review. Once the SEC reviews the proxy statement itself, then both sides are cleared to mail. And there are some mechanics involved in the mailing. You know, from an issuer side, they want to be first out because there are a certain population of shareholders that literally mail back the first proxy they get and never look at another one. Similarly, management's going to want to mail the last fight letter out because there are a group of shareholders that literally tick every proxy card they get. They don't understand the nuanced difference between a white card and a green card and why they're getting two cards for the same meeting, and that the two cards actually represent opposing viewpoints. So we had a proxy fight last year in which every time one side or the other did a mailing, you could see about 1% to 2% of the outstanding shares moved from one card back to the other. Then we would do a mailing, it would move back to us, and this population just moved back and forth over the course of a several-week period.
And you can just, one of the things is the amount of time and effort that goes into these type of proxy contests and distraction of management it cannot be overstated, and the level of involvement actually of your board as well. That it really is that's one of the most significant is the management can very well lose focus on the business because they're fighting this proxy contest, which is the thing that you want to avoid.
So as we're going through these proxy fights, it's essentially much like a political campaign where you're seeking to get the support of shareholders large and small alike, both institutional and individual. The individual shareholders tend to be a little more proactive towards management. However, in the case of a poorly performing fund, that may not be the case. But in a generally well-performing fund, individuals will tend to support the manager. There will be multiple mailings from both sides. There'll be multiple press releases. There will likely be an investor presentation, in which case the members of management and the board will present to ISS and potentially other proxy advisory firms or large investors. The opposing party will also do the same.
And sometimes it's not very civil either.
No, it'll get very personal, and the media will be used. Many of these activists like to see their name in press. They view having their name in press as a positive because it helps them do their own fundraising or asset collecting. If they see their name out there, they think that they'll get more investors in their own fund as a result. And then the last part, as Cynthia touched on, is litigation. Litigation is a very common occurrence in proxy fights.
And then the nature of litigation can be in different forums. They can be looking for to inspect the shareholders list, and what you can do in Maryland versus what you can do in New York is very different. They also may try and stop the proxy contest. They may try and stop the merger. So there's a lot of different things that happen that you've got to be ready for. So just to mention one or two things, and then to jump on to how maybe to prepare yourself, and then go into the ESG portion, is there's a couple unknowns out there that I wanted to mention. one was kind of the proxy plumbing proposals that are out there. I'm concerned that some of these might make proxy contests easier, and the proxy plumbing proposals allow for a universal proxy card where you have to include all the slate of directors that are up. So, for example, when we were talking about the slate that was coming from an activist, whether in fact you're going to need to put them on your card. So I think that's something that's still being obviously debated, and we won't know how that's going to turn out. There's also a proposal on the funds of funds rule that allows basically over 3% to be owned by a fund. We don't know a timing on that, but again, if more activists can buy bigger pieces, you could see how that might be an issue. And then in addition, the no action process, the fact that that's now going to be oral. I don't know that necessarily is going to create more of this type of activity, but you can see where activists may think that they can put more proposals in if they don't have to wait around for comment letters and that type of thing. And that's just a procedural change that the SEC has done. But all of these things coming together with the market, may have some impact. But maybe we can just talk for a second on, what boards might do or management teams might do to put themselves in a position of not having a contest come up against them or an activist come against them.
Sure. Yeah. Certainly, board preparation is very important. Boards obviously need to be looking at following their discounts and benchmarking themselves versus peers, looking at performance, of course. But perhaps things that some funds may not be doing are tracking ownership trends, knowing who their shareholders are, knowing the policies of those new shareholders potentially. So many funds, many investors post their proxy voting guidelines online, or firms like ours, know what those policies are. Also, issuers should be aware of the policies of ISS and Glass Lewis, the two largest advisory firms, both as they pertain specifically to BDCs and closed ends, but also as they pertain to proxy contests in general. ISS, for instance, has a framework how they look at proxy contests, and it's a very simple framework. First, they want to check if the dissidents have met the burden of proof that change is warranted. And if ISS determines that change is warranted, then the second question or second prong of the test is, will the dissidents be better able to affect that change versus the incumbent directors? So how does that pertain to closed ends or BDCs? For ISS, again, very simple. They're going to compare performance and discount versus peers. And it's very important that the issuer define who the peers are. We've seen circumstances where ISS has essentially created their own peer group and really gotten it wrong. So it's key that an issuer be able to define their peer group. Issuers should also look in the mirror, and the board should, look at their own composition, their own diversity, tenure, age, board size. Are any members overboarded? They should understand which, if any, of their board members would be most likely attacked in a proxy contest. They should also evaluate structural defenses. Maybe I'll let Cynthia expand on that, but you want to make sure that you have bylaws and charter that are current and up to date and not 20 or 30 or 40 years old.
Yeah. I mean, I've already described the advance notice provisions, which obviously most folks have, and one of the areas that the proposals have been coming in the closed-end fund space is declassifying boards. So, is your board voted on annually, or is it done by class? There's been a movement to get rid of classified boards in larger corporations. I think this is now something that's going into the closed-end fund space. The SEC has, in some contexts, not allowed certain anti-takeover provisions. So you have to be very informed about what is viable and what's not. So doing the spade work effectively, which is what we're talking about from what you said and what I added on, is really knowing kind of your current performance level, the market, and your governance. So that's really the point. But then again, you also have to know what the break the glass moment is. When do you have somebody who's gotten into your stock that's going to potentially cause issues for you, and how are you going to react? Who's your team going to be? And what does the board want you to do? What is the next step? So, one question that I wanted to maybe ask is, how much of this can a management team avoid if somebody does come in? I mean, how much could it be done informally? I think there's a lot of activity that goes on that's more at a handshake level, that there's not necessarily a standstill agreement but there's action taken. Is that something that's viable in this space?
It is. And I was reading an interview that Phil Goldstein of Bulldog did many years ago, and he flat out said, he looks at how reasonable the manager is and how responsive they are to his requests. If they just hang up on him the first time he calls and never talk to him again, he's much more apt to run a proxy fight. But on the other hand, if they have a civil dialogue and perhaps he asks for a 40% tender and the issuer offers up something much less, but still acceptable to Goldstein, that, there might be a tender involved, but it's not an all-out war for proxy seats or for board seats, and it's not a proxy fight.
Diplomacy might be a key here.
And it's also important that, when an activist calls, you should engage, because down the pike, if this were to go to a proxy fight, and ISS says, so what did you do to settle this? And the dissident says, well, they hung up on me or they wouldn't talk to me, that's going to be frowned upon by ISS, and it's going to make it that much harder to get ISS's support.
So let's take let's pivot over into ESG, which Hannah's going to talk a little bit about, and this is one of those areas where almost every component of it could create an activist situation, from environmental to social to governance issues, which we've already talked about. So maybe you can just give us a little bit of background on what ESG means and how it might fit into some of this that we've been talking about.
Sure. And I mean, to give a high-level overview, I think one of the tricky or perhaps frustrating things about ESG is that there isn't necessarily a uniform definition of it, and it means different things to different people. But that being said, broadly speaking, what we're talking about when we talk about ESG are the environmental, social, and governance risks and opportunities that are key to a company's ability to execute its strategy and to its operations. So starting with the governance, that is not a new subject. It's probably the most familiar to this audience of everything within the ESG space. And we've talked about already some of the ways that can be used in an activist context. Destaggering the board is a classic tactic. But generally speaking, what the focus is here is on things like shareholder rights and board structure. And beyond the fight tactics, what we're seeing from investors is that they're becoming more active as owners, generally speaking, and are focused on board composition and board accountability. And with that, what that means is that investors are increasingly willing to vote against boards where they do not feel that they're appropriately overseeing the company's affairs. So as Chris was saying, we absolutely do recommend that you take a critical eye to your board as an activist might to have that preparation. Moving to the E, here what we're talking about is the impact of strategy and operations would have on the environment, either directly or indirectly. And the social aspect is, again, understanding those impacts as they relate to the company's employees, to its relationship with the community that it operates in, and then to society, broadly speaking. The E and the S topics, they tend to be more company and industry specific, although some of them do have broad applicability, like climate change or diversity and inclusion. And what we're seeing from investors here in the E&S space is how they're approaching this from an institutional investor point of view, is that they're focusing on the ESG topics that they believe are financially material and that will have a long-term impact on the company's value creation. And I think that's a really important point, is that the institutional investor community is approaching this topic from a value standpoint, not necessarily a value standpoint. values comes into play very much, though, when you look at the shareholder proponent space here. But so given that there's this increased desire from investors around this information, there's been a proliferation, really, of frameworks on the one hand, and then data providers and rating organizations on the other that are trying to get at this information, because much of it is currently not required disclosure from an SEC point of view.
Yeah, but let's put this a little bit in context. The funds that are out there today, $21 billion went into this ESG fund last year. Previously, it had been $6 billion for the last 3 years. So as far as there's a lot of focus on raising funds through this ESG area, which it isn't defined.
Absolutely, and that's part of the conversation that's going on here, and something that came out of Davos is around the fact that there is not a taxonomy really around ESG and what does it mean to be an ESG fund. But you're right. I mean, there's the numbers, because of that lack of definition, can be fuzzy. But I've seen up to 26% of assets under management are in ESG strategies. So it's absolutely proliferating as a strategy.
And the SEC is asking questions. They've done a couple of sweep exams, and part of the problem is, one, what is it? How do you measure it? And how do you implement it into your investment process, right?
Yeah, absolutely. And that's something we can talk about. In the interest of time, maybe do you want to just jump to how some of the asset managers are doing that? So, there has definitely been an evolution in how large asset managers have been approaching integration of ESG into their investment process over the last several years. I think there's some very good examples out there, to the extent this is something that the BDC and closed-end space is starting to look at. I think Neuberger Berman is a really good example of a firm that's really ingrained ESG across the investment chain. So what I mean by that is looking at it both on the front end and doing its investment analysis and portfolio composition, as well as in its ongoing stewardship activities, engaging with the company and in its voting. And T. Rowe is another example where they have a lot of information publicly available about how they approach this topic. And in particular, they have some examples within, I mentioned that ENS can be industry specific. They have some useful examples in their policy around topics that might be financially material to the various industries. And also the frameworks that I was going to mention in the disclosure space, the two that are really key that have been coming up a lot that we're hearing from investors they're asking companies to provide disclosure under are SASB and TCFD. SASB is the Sustainability Accounting Standards Board. That's been an investor-led effort, and that is a useful resource to look at if you're starting to try to understand this space. The BDC community would be an asset manager under that classification system, as you would expect, and that provides an overview of a handful of topics that are being viewed as financially material from an investor point of view to your industry. And largely what that goes to for a BDC is taking a similar approach to how the investor community at large is looking at this. So in your own credit analysis activities, for example, when you are deciding companies to lend to or invest in, how you are incorporating these ESG factors into your investment process would be something that SASB would be interested in seeing disclosure under, for example.
Right. I mean, we're really at kind of the almost the, I don't know if I want to say the dawn of this, but as far as making sure people understand what it means, and if they don't understand what it means, it actually is an opening for activism at some level, not to mention regulators, as well as other folks who are looking at whether they can come up with a taxonomy or a rating on what this means. But this will not be the last time anybody hears about this concept, and that BDCs haven't necessarily talked a lot about this. There is some disclosures out there about the ESG being a part of their process. Yeah. But again, this is something that I think that is going to morph and continue over the coming years and only get bigger. especially with climate change, all types of, sustainability issues. I mean, the largest asset manager, BlackRock, came out and said that sustainability is at the heart of all of their businesses, which means that means that this is going to be a part of all of their funds. Is that
absolutely? Yeah, I mean, the Larry Fink's letter this year was specifically focused on sustainability and climate change. That's not new that BlackRock is talking about those topics, but the tone and tenor of that letter represents a significant shift in that for BlackRock and its activities historically, it's been engagement-led and how it's approached these topics. And what I mean by that is that how it's been encouraging disclosure has been through engagement with companies. The philosophy within BlackRock was that a vote against a director or a vote in favor of a shareholder proposal represented a failed engagement. And that is no longer the case. And if you look at their revisions to their guidelines this year, they've removed that language. And what they said in that letter is that they will be increasingly willing to vote against directors and in favor of shareholder proposals where the company is not appropriately managing these ESG topics and is not providing disclosure. And in that letter, they did actually specifically indicate that they are looking for companies to provide disclosure under SASB and TCFD. TCFD stands for Task Force for Climate-Related Financial Disclosures and is climate specific in nature, as its name suggests.
So this is almost a to come. I'm sure we could do a whole presentation on ESG, but defining, implementing, measuring, all of those things are still kind of up in the air, and everybody's taking their own positions on it. So we'll definitely be talking about it in the future. I have one question that I will ask and see if I can get a quick answer on Chris. It said, is there a tendency for shareholder proposals to do better in a vote, tender versus termination, a manager versus declassifying versus nominations?
I can give a real long answer to that, which I won't do, but typically what I do is look at the shareholder base, figure out who the shareholders are, and then generally speaking, institutional investors are going to be highly supportive of declassifying a board. Proposals to just terminate a manager without a replacement tend not to do particularly well unless the fund has been struggling. Proposals to do a tender, again, will typically do well if there's a large institutional shareholder component in the fund or BDC. And then director nominations, I'd really say, are a case-by-case basis. But in all of those situations, really the most important thing to do is understand the shareholder base.
Right. And as we've talked about at the beginning, to understand the activists and what their motivation is, and that will help you understand how you're going to, what kind of response you're going to get to the shareholder proposal. So I think that brings us to the end. This went very quickly. I want to thank Chris and Hannah for joining us today on what I hope turned out to be a lively, informative discussion. I want to thank the listeners for joining us and let you know that this webcast will be posted on the publicly traded private equity and on the BDC app, BDC Essentials, and you'll be able to listen to it on there. So thank you again. If you have any other questions that you want to pass on, please just send them in. Thank you.